Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Friday, August 14th, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
So let's just get right into it, because today's data deck is painting a really stark picture for you as an investor.
Yeah, it's a massive paradox right now. Imagine a world where the consumer is actively bleeding out, oil prices are surging past $88 a barrel, and the bond market is loudly flashing inflation warnings.
Right, but then you look at the stock market and it's just, happily asleep at the wheel, barely moving.
Exactly. And today's proprietary updates highlight 4 critical themes driving this whole disconnect.
First, we have a severe growth reality check with this morning's U.S. consumer data miss. Second, there's a massive global rates repricing happening.
Which is actually being led by Europe, right?
Right, specifically a spike in the French 30-year bond. Then third, under the hood of equities, we're seeing this highly complex AI rotation hiding beneath a structural options pin.
And fourth, to top it all off, a stagflationary commodity shock driven by geopolitical supply threats.
Accurate. And that combination is what's really keeping institutional desks on edge today.
Let's start with that macro picture, specifically the growth reality check. The U.S. consumer data that dropped today was just ugly. July retail sales were down 0.6% month over month.
Yeah, which is the worst print we've seen since May 2025.
And the internals are even worse. The control group, which is critical because it strips out the volatile stuff like autos and gas and feeds directly into the government's GDP math, that dropped by 0.4%.
Right. And because of that sharp contraction, our latest run actually downgraded our Q3 GDP tracking by 0.5 percentage point. We're down to 2.2% annualized now.
Which lines up perfectly with the University of Michigan Sentiment Index. It just plummeted down to 51.0 today.
When consensus was sitting up at 55.0.
Exactly. So people are feeling stretched. They feel poorer. Now, logically, if consumer demand is falling off a cliff, you'd expect interest rates to drop, right? Because the market anticipates the central bank stepping in to cut rates.
You would think so. But moving to today's data, we saw the exact opposite. Despite the weak growth, yield actually rose globally.
It's a complete contagion effect.
It really is. The French 30-year yield hit 4.85%, the highest since 2008, and that dragged the U.S. 10-year yield up 5 basis points to 4.694%.
And the U.S. 30-year yield pushed up to 5.263%.
Right. And looking at the terminal rate, the market has completely recrossed that 4.03% threshold. Today's pricing has the path peaking around the July 2027 meeting.
At about 4.01%. Yeah, so less confidence in near-term cuts and a much higher ultimate cost of capital.
Exactly. Mechanically, the market is experiencing a severe bear steepening of the yield curve, which is driven almost entirely by term premium expansion.
Okay, wait, I need to pause you right there. Because bear steepening and term premium expansion, that just sounds like abstract financial engineering if you don't stare at a terminal all day.
Fair point.
Let's break that down for you using a first principles approach. Think about it like a bank evaluating a mortgage applicant.
Okay, I like that.
So say the applicant has a fine short-term credit score. They can pay their current bills right now. So the bank keeps short-term lending rates steady, but
the bank looks at the applicant's horizon, right? And they see long-term career instability, rising living costs, and, massive inflation threats over the next decade.
Right. So to compensate for locking up their money for 10 or 30 years in that uncertain environment, the bank demands a much higher interest rate on the long-term loan.
That is exactly what the global bond market is doing to sovereign governments right now. They're demanding significantly more compensation to hold 30-year debt, regardless of the weak retail sales.
They're essentially saying the inflation risk outweighs the slowing growth risk.
Precisely.
So given that rising long-term cost of capital, how are equity portfolios repositioning? On the surface, the S&P 500 closed down just 0.17% today at 7,785.76. It barely blinked.
Undeniably. But that calm surface is a complete illusion. Our daily death data shows a massive $128.8 billion net positive long gamma print today.
That effectively pinned the market right at 7,800.
Right. It completely suppresses volatility.
Let's clarify what an options pin means in practice. Think of it like bowling with the bumpers up. When dealers are heavy long gamma, they're forced to trade against the market's direction just to keep their books neutral.
So the market dips a little, they mechanically buy. If it rises, they sell. It creates this air pocket that cushions the index.
But beneath that artificial pin, the flows tell a totally different story. Hedge funds bought U.S. equities every single day this week.
Yeah, but retail investors are shifting away from broad tech and moving heavily into macro ETFs.
Understood. But wait, retail is fleeing tech while hedge funds are buying every day? Who's driving the bus here? Those are totally opposite bets.
On that point, let's drill into the specific tech action, because it's a very complex intra-AI rotation right now. The global AI trade is alive. The Kospi index surged 2.42% today.
But domestically, there's this fierce divergence. Broadcom, ticker AVGO, dropped 5.94% today.
And Applied Materials, ticker AMAT, fell 5.12%.
Right, and they fell even after reporting a beat and raise quarter. It's like the market decided their results were a high bar, not good enough situation.
Exactly. Price for perfection. Meanwhile, Advanced Micro Devices, ticker AMD, gained 6.5% today.
And SanDisk, ticker SNDK, jumped over 13% after their investor day.
Which was driven by them committing to return 100% of excess free cash flow to shareholders. Plus, you can't ignore the sheer scale of infrastructure capital mobilizing.
Yeah, NVIDIA, ticker NVDA, partnering with Apollo Global Management, ticker APO Blackstone, ticker BX, and KKR.
They're mobilizing $500 billion specifically for AI infrastructure over time. It's staggering.
And that capital requirement is causing massive sector rotations. Value stocks via the IWD are up 10 consecutive weeks. Financials via the XLF are up 7 weeks.
We even saw Workday, ticker WDAY, jump nearly 18% purely on Silver Lake buyout rumors today.
I do have to push back on this overarching AI dominance narrative, though. We talk about $500 billion for infrastructure, but our latest run shows only 11% of S&P 500 companies actually quantified any positive AI productivity impact in Q2.
That's a sobering stat.
Right. So for 89% of the index, the bottom line effect is zero.
Are we just blindly trading the hardware, the picks and shovels, assuming the enterprise software adoption will inevitably follow?
It's the critical vulnerability in the market's logic right now. You can only build data centers for so long before the software needs to generate actual profits.
Pivoting to commodities and hard assets. If equities are rotating to value and bonds are flashing inflation warnings, what is the physical world doing?
Well, it's all about severe supply shocks right now. The energy complex is driving that stagflationary undertone we mentioned. Brent crude surged 2.09% to $88.82, and WTI hit $82.40.
Driven by unprecedented U.S. economic isolation measures against Iran and real escalation threats in the Strait of Hormuz.
And our internal desk data shows it's migrating rapidly into refined products. The distillate markets are tightening extremely fast.
Affirmative. And you can't print more oil. This structural fear is pushing both retail and institutional money right into precious metals for safety.
Retail flows into the gold ETF, ticker GLD, and the miners ETF, ticker GDX, are at their highest since February.
New month, ticker NEM, has climbed 25% this month alone.
But the most unusual dynamic is happening in industrial metals. We're seeing a bizarre divergence in global copper.
Yeah, on the London Metal Exchange, LME stockpiles are plummeting into deep backwardation. Immediate physical supply is so scarce, buyers are paying a massive premium.
Yet simultaneously, U.S. CME inventories are swelling.
Almost certainly anticipating tariffs. Supply chains are hoarding physical material domestically because global supply is tightening.
And think about the psychology of that for a second. Investors are aggressively buying gold, the ultimate defensive safety asset, while simultaneously hoarding copper, the ultimate cyclical boom asset.
It indicates extreme macro uncertainty. Capital is hedging against a recessionary collapse and a manufacturing supply shock at the exact same time.
Concur. Which really brings us to the synthesis of today's data deck. We have to connect these dots to define the actual economic regime we're in.
The core contradiction is glaring. We have all-time equity highs driven by AI infrastructure spending and options pinning.
But underneath, you have a bleeding U.S. consumer evidenced by retail sales and 30-year yields spiking because of an $88 oil shock.
Precisely. And the credit markets are actively flashing a warning. If you look at broad investment grade or even standard double B corporate spreads, they look fine.
But if you drop down to the lowest tier...
Right, the triple C credit spreads, those zombie companies, those spreads have blown out to 833 basis points, which is the 99th percentile.
Noted. It shows severe underlying distress at the margins, which sets up a massive collision course for next week.
Oh, definitely. We're entering the tail end of Q2 earnings, and the focus shifts entirely from AI to the consumer.
We have the retail gauntlet reporting next week. Walmart, ticker WMT, Target, ticker TGT, Home Depot, ticker HD, and Lowe's, ticker LOW.
The market's going to be hyper-focused on those calls.
And that leaves you with a vital question to ponder over the weekend. If the S&P 500 is trading at record highs based on a Goldilocks soft landing scenario, how does that math hold up next week if consumer giants like Walmart and Home Depot confirm the severe demand destruction we just saw in today's retail sales data?
That is the defining tension right now. Eventually, one of these realities has to break.
So to quickly recap before we sign off, growth is slowing down while inflation risks from oil and rates are rising. It's creating a stagflationary undertone that's temporarily hidden beneath a calm, options-pinned equity market. Thank you for listening to Market Pulse by Orestes Capital, where Elena and Marcus will be back next week with the latest market color. Have a good weekend.